Welcome to the Pro Ticker Deep Dive.
It's great to be back, and honestly today the situation in the markets is just, well, it's a little dizzying.
Dizzying is definitely the right word. I just want to mark the date for everyone right up front because things are moving at absolute warp speed. It's January 30, 2026.
Right.
And if you've been watching the screens this month, you have seen European natural gas prices just absolutely rip. We're talking a 40% spike.
In a single month. It's a massive move, and if you just look at the headlines, it looks like a full-blown crisis.
It does.
You've got this brutal cold weather, freezing the continent. Storage levels have dropped to 43%.
Which is way low, right?
Way below the 60% average we're used to seeing this time of year. So traders are, they're clearly getting nervous.
Right. It feels like panic mode. The screen is flashing red. But, and this is the twist that really got me for this deep dive, the data we're looking at is telling us that this panic might be wrong.
Or at least incredibly short-sighted. That's exactly it. It is the central tension of this whole thing. On the surface, right now, today, the market looks incredibly bullish.
For sure. Short on gas, prices screaming higher.
But if you peel back the layers, there is this bearish structural reality that is literally just around the corner.
So we're really looking at a contradiction.
A massive one. I mean, you're seeing Europe locking itself into a geopolitical pivot that makes it incredibly vulnerable right now.
Right, yeah.
But at the same time, the United States is getting ready to flood the world with so much liquefied natural gas LNG that we are entering what analysts are calling an oversupply supercycle.
An oversupply supercycle. I like the sound of that. So our mission today is to unravel this. We're going to look at the Russian gas ban, this explosion of U.S. export capacity, some very surprising numbers out of China, and then figure out what it all means.
It's a fascinating setup.
Yeah.
You have short-term scarcity meeting long-term abundance. It's a collision course.
Okay, let's unpack this. Start us off with Europe, because this week was historic for reasons that go way beyond just a price spike.
It was. Just a few days ago, January 26th, the EU formally finalized the ban on all Russian gas imports.
All of it.
All of it. We're talking a total phase-out of LNG by the end of this year, and pipeline gas is gone, completely gone, by September 2027.
That feels like the final nail in the coffin for an era that's been slowly dying since 2022. Finalizing it, that puts a hard date on the calendar.
It does. And to really get the scale of this, you have to look at where we came from. In early 2022, Russia supplied 40% of Europe's gas.
40%.
By 2025, that was already down to 13%. By late 2027, it will be zero, not a single molecule.
Which begs the obvious question, if they aren't getting it from Siberia, where are they getting it? People still need to heat their homes.
They're looking west. They're looking at the United States. This decision effectively locks Europe into a high-dependency relationship with the U.S.
How high are we talking?
Right now, American exports account for 56% of European LNG imports. The forecasts we're seeing say that's going to hit 80% by 2030.
80%. That is a lot of eggs in one basket, especially a basket that has to cross an ocean.
It is. And this brings us to a really crucial concept for understanding the volatility right now. Europe has become the marginal buyer.
The marginal buyer. Okay, break that down. What does that mean in plain English for the gas market?
Think of it as being the swing market. Most buyers, like, say, big utilities in Asia, they have long-term contracts. They pay a fixed price.
Right.
Europe doesn't have as much of that. Europe is now the buyer of last resort. So when global supply is tight like it has been this January year, Europe has to bid the highest price to attract the cargoes. They have to scream, "Over here, we'll pay whatever you want."
And that explains the 40 euro per megawatt hour price we saw. They're literally outbidding the rest of the world to turn the ships around.
Exactly. They had no other choice. But the flip side is true too. When supply is loose, they're the first ones to cancel orders.
Ah, so they say, actually, we're full, thanks.
Precisely. So being the marginal buyer is a double-edged sword. You set the floor and you set the ceiling.
And right now, we are absolutely seeing the ceiling. It wasn't just the cold, was it?
No, it was a perfect storm. You had the cold weather, sure. You had production outages in the U.S. from their own winter storms. And then you have the Strait of Hormuz risks with, tensions there. It all just exposed how fragile Europe's energy security really is.
It's like walking a tightrope without a net.
That's a great way to put it. And right now, the wind is blowing hard.
So Europe is sweating. But you mentioned earlier there is a wall of supply coming. Where is that coming from? Because if I'm in Germany looking at my heating bill, I am praying for supply.
It's coming from the other side of the Atlantic. While Europe is scrambling, the United States is in the middle of a historic infrastructure boom.
Mm.
We need to pivot to the supply tsunami that's building.
Tsunami. Okay. In 2025, we hit a pretty big milestone on exports, didn't we?
We did, a huge one. In 2025, the U.S. became the first nation in history to export over 100 million metric tons of LNG in a single year.
100 million.
We actually hit 111 million tons. That's about a quarter of the entire global supply coming from just one country.
And that was last year. What's happening in 2026? Are we slowing down?
Not even close. The pipe is getting wider. I mean, you have Plaquemines LNG, which only started shipping in December 2024.
Right.
It's already handling 17% of U.S. exports. It ramped up unbelievably fast.
17% from one new facility? That's huge.
It's massive. And then you have Golden Pass. That's the venture between one of this year, 2026. Then you have Corpus Christi Stage 3 coming online.
And just for clarity, when you say train, we aren't talking about railroads.
Right, sorry,
No.
LNG speak. A train is the liquefaction unit itself. It's the giant industrial facility that freezes the gas. These are multi-billion-dollar machines, and we are turning them on one after another.
It just sounds like we're stacking capacity on top of capacity.
We are. And it's not just the U.S. I mean, you also have Qatar's North Field expansion ramping up in mid-2026. Argentina's Vaca Muerta project is on the horizon.
So it's global.
It's a global phenomenon. The capacity that usually takes decades to build
Yeah.
is essentially being replicated in a 5-year span between 2025 and 2030.
That is just wild. We are doubling down on this infrastructure at a speed that's hard to wrap your head around.
And that is why we call it the oversupply supercycle.
Right.
We're building these factories to liquefy gas faster than the world has ever seen. We are creating a structural glut.
Okay, but basic economics, right? Who is buying all this gas? I mean, I assume China is thirsty for energy. They always are.
Well, this is where it gets really interesting. This is the demand disconnect part. Everyone just assumes China will soak up whatever excess LNG the world produces.
Right. They're the world's factory. They need the power.
They do. But the data coming out of China is surprising a lot of people. Their LNG demand is actually declining. It's down 0.6 million tons in 2026.
Declining. That does not fit the narrative at all. Why?
Two big reasons. First, they're ramping up their own domestic shale gas production way faster than expected. They're drilling at home.
I didn't even realize they had a big shale industry.
They do, and they're pushing it hard. But the second reason is even more critical. They're relying more on pipelines from Russia.
So while Europe is banning Russian gas, China is buying it.
Exactly. The gas that Europe rejects flows east, and so China just doesn't need as much American LNG. It's a giant game of musical chairs.
So the savior of the American export market, China, isn't showing up to the party.
Not in the way people expected. And then you look back at Europe, sure, they're buying for heating now. But their industrial base is weak. Those energy-intensive sectors are they're operating at depressed levels.
So that industrial demand isn't there either. What about the rest of Asia?
The buyers in places like India or Southeast Asia, they're incredibly price sensitive.
What's the magic number for them? When do they walk away?
The data suggests it's right around $11 per million BTU. If the price goes above $11, they just disappear. They switch to coal, or they just reduce consumption. They ghost the market.
Okay, let me get this straight. We have U.S. supply exploding. We have China drilling its own gas and buying from Russia. Europe's industry is struggling. And other Asian buyers walk away if the price gets too high.
Okay, that's the verdict. The market is producing more gas than the world currently needs.
So what does this mean for prices? I mean, we started this talking about a 40% spike. Are we staring down a cliff?
We are. The consensus forecast for 2026, this January spike notwithstanding, is for prices to average between $9.50 and $9.90 per million BPU.
And compare that to 2025 for us.
In 2025, the average was $14.41.
Wow.
So yeah, we're talking about a 30 to 35% collapse in average pricing year over year.
That's a crash. That is asset repricing territory.
It is a massive correction. We expect the European benchmark, the TTF, to drift toward 30 euros by Q2 and maybe down to 25 or 28 by the end of the year.
If I'm a U.S. exporter, I am getting nervous right now because at some point it stops being profitable to ship the stuff, right?
You should be. It's all about the margin squeeze. As long as the Henry Hub price in U.S. stays low relative to Europe, you make money. But as global prices fall into that $8 to $11 range in 2027, the high-cost projects, they are going to bleed.
Have we seen any casualties yet, or is this just theoretical?
Oh, we have? We have a body count. Look at Energy Transfer. In December 2025, they scrapped the Lake Charles LNG project.
That was a huge project, wasn't it? I remember reading about that for years.
Huge. A major developer basically looked at the math and said, this doesn't work. They admitted that in an oversupplied market, the project just doesn't fly. We're going to see more of that.
It's fascinating. Usually you hear about canceled projects because of regulations, but this is just cold, hard capitalism. The market is too full.
It's market physics. You can't fight the supply and demand curve forever.
Well, speaking of regulations, let's talk politics. We have a Trump administration in the White House. The rhetoric is energy dominance. How does that square with this oversupply reality?
This is the policy paradox. The administration is pushing hard, executive orders to accelerate LNG permits. They want to flood the world with American energy.
And on paper, that sounds great for the industry.
On paper, yes. But the reality is, it's a lot messier. Look at Commonwealth LNG. They finally got approved in February 2025. It was supposed to be a victory lap. But are they building? No, because the legal battles just moved from federal courts to state courts. In October 2025, a state judge in Louisiana revoked a coastal permit for them.
So the president says go, but a local judge says stop.
Precisely. And that's the key insight. The permitting noise creates volatility for a day. But it doesn't change the underlying reality. Trump can reduce the process risk, make the federal paperwork go faster, but he can't eliminate the project risk caused by falling prices.
The market forces are stronger than the executive orders.
Always. Supply versus demand is undefeated.
There's another angle to this, right? If we're exporting so much gas, what does that do to prices here at home for Americans?
That is the narrative the administration hasn't really addressed. It's a paradox. If we export massive amounts of gas, we are tightening our own domestic market.
Which means our prices get pulled up toward the global price.
Right. It could squeeze U.S. prices higher. You could see a scenario where Americans are paying more to heat their homes, specifically because we're so successful at selling our gas to Europe.
That's a tough sell to the voter. Your heating bill is up, so we can help Germany.
It is a very difficult political needle to thread.
So we have this incredible picture. Europe is desperate now, but about to be flooded. The U.S. is building like crazy, but into a glut. China's looking away. And prices are set to tumble.
That pretty much sums it up. It is a market in a massive transition.
So for the listener trying to make sense of this, what is the asymmetric bet here? How do you play this without getting burned?
The asymmetric bet is recognizing the timeline. The market right now is pricing in short-term tightness. Winter 2026. That's justified. It's cold, storage is low.
But don't get fooled by it.
Exactly. The market is sleepwalking into a massive glut by 2027. Do not extrapolate January into forever. That is the classic mistake.
And Europe's leverage as a buyer.
It is temporary. By late 2026, the question is going to shift. It won't be, can we get enough LNG? It will be, who has to cut production?
That is a complete 180-degree turn.
It is. And when that happens, the companies that survive are the ones with the lowest costs. The high-cost producers are going to get washed out.
It sounds like we are in a transition phase, a dangerous one.
We are. The next 18 months are the window for volatility. You're going to see wild swings as we go from scarcity to abundance.
And I guess for the savvy observer, the real winners aren't the ones betting on a continuing shortage.
No, the real winners are the ones preparing for the flood. The flood is coming.
Well, that is a provocative thought to leave us with. We're on the beach, watching the tide go out, knowing a tidal wave of supply is just over the horizon.
It is going to be a fascinating year to watch.
It certainly will be. Thank you for walking us through the madness.
My pleasure.
And thank you for listening. Keep your eye on those storage numbers and don't let the daily volatility distract you from the long-term trend. See you all in the next Pro Ticker Deep Dive.